Alright guys, in this video we'll discuss that cat bounce chart pattern. So basically this is a downtrend continue pattern. So once they form, it is confirmed that price will continue toward the downside. Alright, so here we will discuss this topic only. So before I start, please like and subscribe. Once I'm releasing new content, so definitely you will get the notification. How we will identify after gapping down a stock, it will continue toward the downside. So this is the head. So this dead cat bounce pattern tell us it will continue toward the downside or it will bounce from this area. For example, suppose the stock price right now is 100 rupees, somewhere there, and the next day price gap down by 5%. Now let's see price next day open around 95 rupees, and again price continue to the downside, and this 5% now it's become 8%. So once price hit 8%, after that price are giving a pullback and near opening point. After that, if price again start falling, that is called dead cat bounce. So why is it happen? So we'll discuss later. To become a dead cat bounce, gap down should be near 5%. If gap down is 4% or 3%, it is not recognized as a dead cat bounce. Down should be more than 5%. Or if suppose some stocks open near 3% and gap down near 3%, and it should continue to the downside and fill up at least 5% gap down. Alright, so some stable stock not able to gap down by 5%, it gap down by 3%, but in the same day this 3% should be near 5%. Like open price was somewhere there, open somewhere here, and this range was 3%, and in the same day price should continue to the downside and it should be 5% gap down. So in that case we recognize as a dead cat bounce. Sustained decline. Suppose price was somewhere there and gap down by 5% within 5 minutes. So here I can see this is the 5-minute chart. After open somewhere there and within 5 minutes price continue toward the downside. It's a sustaining at least 5 minutes toward the downside. If price opens somewhere there and goes up, it's not called dead cat bounce. At least 5 minutes price continue toward the downside. So in a small time frame, this is the large time frame, daily gap down, and this one is small time frame like 5-minute chart. So first 5 minutes, have you seen it? Price continue toward the downside. So after that price again pull back. To become a dead cat bounce, at least 5 minutes or more, price should decline toward the downside, or it will continue toward the downside after gapping down. Next, the decline resume. So after gapping down, first 5 minutes, this one 5 minutes, price should continue toward the downside, and after that price should resume or pull back near opening point. Once price resume or pull back near opening point and again continue toward the downside, if price is rallying toward the downside, it is called dead cat bounce. Once they appear this type of pattern, it is a probability that the price will continue toward the downside. Cause of dead cat bounce. Some fundamental news, stocks gapping down very violently, or when stocks releasing their earning and very bad earning result, price gap down very violently and continue toward the downside. That was open and at least 5 minutes continue to the downside. After that, price pull back and form a bearish candlestick pattern. We place sell order, sell limit order. So next candle is a triggered our sell order and continue toward the downside. Stop loss and price target. So we once place our sell order below this candle, we place at least one ATR above this opening point. Somewhere here I can see, or you can say like higher point, this 5-minute higher point, one ATR above, one ATR above this candle. So if you don't know about the ATR, you just go to I bottom. So here you will find how to use ATR perfectly. And our target will be around somewhere we are following 1:2 ratio. Suppose this area is a 1 rupees, our target will be around 2 rupees. That is our profit target. Alright, if you like this video, please like and subscribe. Thanks for giving your valuable time.